What if your children lost hundreds of thousands of dollars in taxes just because you lived in the wrong state? Most people don't realize this, but Washington State has one of the strictest and most aggressive estate tax systems in the entire country. And it gets worse. The threshold for being taxed is far lower than the federal exemption. And once you're over that line, your estate could be taxed up to 35% before your family ever sees a dime. But here's the good news. There are legal, ethical strategies to reduce and in some cases eliminate your Washington estate tax liability. This isn't about loopholes in a sketchy sense. It's about state-sanctioned tools that most residents simply don't know exist. This is completely avoidable if you know how to plan ahead. Hi, I'm Jason Gray, an estate planning attorney practicing here in Washington State. And in this video, I'm going to show you how the Washington estate tax system works, how it's different from the federal system, and most importantly, the overlooked planning strategies that can help you dramatically reduce the estate tax burden on your family. If your total assets, including real estate, investments, life insurance, and retirement accounts add up to more than $3 million, then this video could save your family hundreds of thousands of dollars. Let's break it down. Let's start with the basics. What is the Washington estate tax? The Washington estate tax is a tax that's imposed on the transfer of wealth at death, but only if your estate exceeds a certain size. Right now, that threshold is $3 million. Anything above that is taxed on a sliding scale that reaches up to 35% depending on the total value of your estate. This is important even if you don't owe any federal estate tax, which currently only applies if your estate exceeds over $15 million, you could still owe significant state estate taxes in Washington. Washington is one of the few states that does not conform to federal estate tax exemptions. And here's the danger. People think they're safe because they're well below the federal limit, but in Washington, it's an entirely different story. Let's talk about how to legally navigate that. If you're married, your estate can pass to your spouse completely tax-free at death, thanks to what's called the unlimited marital deduction. But here's the trap that most people fall into. If you don't plan correctly, your entire estate will be taxed when the second spouse dies, and you'll have missed the chance to preserve the first spouse's exemption. Washington does not allow portability of estate tax exemptions between spouses, unlike the federal system. This means that the first spouse's exemption simply disappears unless you've done proper planning. Strategy: set up a credit shelter trust, also known as a bypass trust or family trust, in your estate plan. This allows each spouse to use their exemptions separately and effectively doubles the amount that you can pass tax-free to your children. Failing to set this up can result in the loss of hundreds of thousands of dollars in tax-free protection. I've seen it happen to people. Washington State does not impose a gift tax. That sounds great, but there's a catch. If you give away assets within 3 years of your death, those gifts are pulled back into your estate and taxed as if you never gave them away. That's known as the clawback rule. So if you're thinking about giving away property, cash, or business interests, timing matters. Federal law allows you to gift up to $18,000, depending on the year, per person, completely gift tax-free. Married couples can double that and give away $36,000 to each individual they want to gift to. Smart strategy: start a gifting program early, well before you face any health issues, and spread those gifts out over several years. It reduces your estate value while keeping you under Washington's gift clawback radar. Here's something most people completely overlook. If you own a life insurance policy on your own life, the death benefit is included in your estate for Washington estate tax purposes. So even if you only have, let's say, 1.5 million in real estate investments, $1 million policy could start to push you close to that threshold of being taxable, and that tax can go up to 35% of your estate. The solution there, if we're around that $3 million mark, is establish an irrevocable life insurance trust, or an ILIT. That keeps the policy out of your taxable estate, ensuring that your family receives the full benefit tax-free. This strategy alone has saved clients of mine hundreds of thousands of dollars. If you're planning to help grandchildren or children with college, a 529 savings plan offers two big benefits. First, the money grows tax-free if it's used for qualifying educational expenses. Second, you can reduce your taxable estate by front-loading contributions. In 2025, you could contribute up to $90,000 per child in 1 year by using the 5-year election, and it won't count against your lifetime gift exemption. That's a powerful way to reduce your estate quickly while still supporting your family in a meaningful way. Washington's estate tax system offers a full 100% deduction for charitable gifts. That means anything you leave to a qualified nonprofit, whether through your will, trust, or a charitable remainder trust, comes off the top of your taxable estate. Even if you're not philanthropically inclined, small gifts to charity can help you manage your tax threshold and push your estate just below key tax brackets. And if you are charitably inclined, tools like charitable remainder trusts or donor advised funds allow you to support causes you care about while receiving major estate tax relief. If you own a farm, timberland, or family business, Washington has special use valuation rules that may allow you to reduce your estate's taxable value significantly. These provisions are often underutilized because the paperwork is complex and strict, but with professional help, they can preserve generational wealth and reduce taxable estate value by hundreds of thousands. Also, when transferring business interests, valuation discounts such as lack of marketability or minority interest discounts can legally reduce the reportable value of those interests by up to 30 to 40%. Let me tell you a couple of important considerations. Washington residency rules matter. If you move out of state but die within 6 months, your estate may still be subject to Washington estate taxes. Out-of-state real estate is excluded from Washington tax, but you'll need to prove it with detailed records. No portability in Washington means married couples must proactively plan if they want to use both exemptions. Assets like retirement accounts, homes with appreciated value, and business equity can cause people to cross the threshold without even realizing it. The reality is most people don't think of themselves as rich, but if you live in King County, own a home, have a retirement, savings, some investments, you could easily exceed that $3 million mark. Estate planning in Washington is not something you do once and forget. You need to update your plan as you acquire new properties or assets, tax laws change, or your family structure changes, divorce, new grandchildren, remarriage, etc. Also, don't forget documents like a pour-over will, updated beneficiary designations, and asset inventory lists, all of which should be reviewed every couple of years. Without maintenance, even a perfectly crafted plan can fall apart. If you live in Washington and your estate is approaching or over $3 million, the clock is ticking. Failing to plan could cost your loved ones hundreds of thousands of dollars and potentially force the sale of family assets to pay the tax bill. But the good news is, with proactive planning, this is all avoidable. Click the link below to book a consultation. Let's create a custom estate plan that uses all the legal strategies Washington allows to protect your assets and preserve your legacy. And if you found this video helpful, check out my next one. YouTube thinks you'll love it.